Giving us your view. Well, let's get back. The market for now is absolutely quiet, actually. Flat. The bank nifty is just holding up a tad bit, but otherwise it's just consolidating around these levels. Well, yesterday we told you that Apple has decided to begin making the iPhone 14 in India just 2 months after China in a move to reduce dependence on the country. To discuss this and the overall business outlook, we're joined by Saurabh Gupta, the CFO at Dixon Technologies, who's also in this space. Saurabh, thanks a lot for joining in. First, on this move of Apple manufacturing the iPhones in India, how do you think it could change the industry dynamics?
Oh, that's a big one because clearly, as you rightly mentioned, it's just been 2 months that China manufactured this iPhone 14, and within 2 months, India has started manufacturing. So clearly, the strong policy framework, the government policies are clearly playing out, and Apple clearly wants to make India as a manufacturing hub. Internationally, they want to shift some of the supply chains from outside China to India, and India is a big beneficiary. So overall, this electronic industry would really benefit, and it is a big one for India.
Saurabh, hi, good morning. But could you, so that's a general comment, but could you, specifically, how will this play out in your assessment? You would have a slightly deeper understanding, right? What does it mean for the Indian ecosystem, manufacturing ecosystem?
Yeah, so if you look at the whole mobile production link incentive scheme, there were 5 foreign players who were given this approvals and 5 domestic guys, including players, one of the companies in which we were a beneficiary in the domestic category. Now, clearly, what it does is that the bigger guys of Apple suppliers, Foxconn, Pegatron, and Wistron, they will make bigger investments in India. It will help in creation of a component ecosystem in India, which will ultimately be a beneficiary. Everybody, all of us will be a beneficiary of that. And ultimately, India will emerge as a manufacturing hub for not only catering to the domestic market, but also for serving the global markets. So Apple clearly wants to make a big manufacturing hub and source a significant portion of its global production out of India.
What does Apple make in India right now, Saurabh?
It's done in South India by this Foxconn, Pegatron, and Wistron. So these are the suppliers. But what it will do once these bigger guys come in.
What products, Saurabh?
Come again?
What products are made right now?
So Apple, as of now, is making. These guys are only making iPhones for them. The iPhone 12, 13, 14 are getting made in India.
Okay. Coming back to your own business, can you tell us what are the demand trends looking like now? Because we spoke to you during your Q1 numbers, and you know, a lot of those, there's some pressure that you're seeing, especially in places like consumer electronics, which saw a fall of around 26%. The growth in some of the other segments has also slowed down a tad bit. There is a lot of competition, but can you just tell us segment-wise, what kind of growth are you looking at? Where are you still facing stiff competition?
So Surya, the demand across all the verticals looks very healthy. So we have a very strong order book across all the verticals, and in most of the verticals, we are running at 100% capacity utilization today. So we are looking for a very good festive season, and we hope this momentum continues beyond the festive season as well. So we are clearly looking at a strong Q-on-Q growth as well as Y-on-Y growth this quarter.
Saurabh, sorry, just to kind of complete that point on Apple, is there any opportunity, is there any way Dixon can participate in this entire thing?
Yeah, we would love to participate. Clearly, as you know, we are already manufacturing for some of the global brands like Motorola, Nokia, and some of the Indian brands. But yeah, if given an opportunity, why would Dixon not like to participate? Clearly, it's a big opportunity, and if opportunity comes to us, we would definitely like to participate.
As of now, it isn't there, right? You'd like to, but as of now, yeah, okay. You know, the last time you were on, you'd said that you'd basically lowered the FY23, the full year revenue growth, by about 10%, 7 to 10% as compared to what was earlier assumed. How's that playing out? I mean, you know, I was looking at the last month sort of cell phone sold data, I mean, smartphone shipments data, that has seen a very sharp dip. So are things slowing down more materially as earlier assumed, or would you stick with that earlier guidance that maybe, you know, it'll be 7-10% cut and not more?
Yeah, we would stick to that guidance because clearly what you are mentioning is we also saw a dip in both Q4 and Q1 in the mobile shipments, and clearly the domestic market slowed down for mobile phones. However, in our case, basically we are exporting a significant portion of our mobile phones to North America markets for our anchor customer. So that market continues to do well. But yeah, the domestic market is presently was slightly slower, but it's getting better month on month. And as of now, our order book with our anchor customer and other customers in mobile looks healthy for the festive season.
But also cut your volume guidance for TVs to 3.6 million from 4 million earlier, and you had said that there's a global slowdown in the TV segment. This is when we spoke last. Will you hold on to the 3.6 million target, or do you think that you may have to slash it down further?
No, we are confident of meeting 3.6, 3.7 million. So there should be a volume growth of almost 20% from similar numbers last year. However, in terms of revenues, the growth may not be, will be muted because the prices of the display, which is a significant component which goes into making an LED TV, those prices have come down. And it's a prescriptive business for us. And basically the prices are just passed on to the consumer. So the margins will optically look better, but in volume terms will grow by 20-25%.
Okay. So overall, what would this mean? You said that the margins for the full year would be at around 4 to 4.5%. At least this was the guidance earlier. But you also told us that commodity prices have cooled off, freight costs have come down, and that will benefit margins. So how much do you think all of this would impact the margins, by the end of the year?
Yeah, so Sonia, if you look at our ODM business margins in Q1 against the Q3, Q4 of last year, those have been on an upward trend, and we see that trend would continue because clearly the sea freight rates have come down, the commodity prices have softened, so which will have a positive impact on our ODM business, which is almost 20% of our revenues. So yeah, we stick with the guidance of 4%. I think so 4.5% would be tough, but we stick to the guidance of 50% growth in revenues, 45 to 50% growth in revenues from last year, and a guidance on margin should be somewhere around 4% this year.
Right. Saurabh, broadly speaking, is there, that's the feedback when we speak with analysts, etc., who track the space. Is there pressure on volumes? So while people are expecting, so for example, take the July to August period, July to September period maybe, right before the festive season sort of gets in full swing, sort of flat to 5-7% kind of value growth, but volumes are expected to be flat. Is that a fair assessment?
Yeah, industry may not grow that much, but in our case, we are growing and we have a very strong order book, and we will have a very strong growth because clearly we are the brand behind the brands, and we work across for multiple customers, and some of the customers for whom we are manufacturing are relatively doing better in the marketplace. So we will see a significant growth, but you're absolutely right. The market growth may not be that much what we saw last year.
Okay, all right. Saurabh, thanks a lot for joining in and talking about the demand picture. So that is Dixon Technologies. Let's slip into a quick break. Up next, we'll connect with Pawan Kumar of IGL to discuss the increase in the domestic gas allocation by the government to CGD companies. Later, we'll connect with